Jenny Brown. Welcome to MFB News. Hope everybody is super duper, had a great week and have been out in this beautiful weather. Isn't it just incredible? Freezing cold, mind you. Hence the reason I'm still wearing massive jumpers. But yeah, such a treat to see the sun. Long may it continue. This week, we're going to be doing our usual roundup on what's been happening with swap rates, lender pricing and lender criteria changes. We're then going to take a bit of a look at the property market, what's been going on there, and trying to just kind of bottom out if there's any opportunities for those of you who are planning to invest this year. And there are people who are planning to invest, despite some of the press reports you might read. And then finally, we're going to just have a quick look at all the various bits of legislation. The Labour government are certainly getting very, very busy. There's a few things going on which are going to impact landlords, some more than others, but I think it's just worth making sure that everybody is across all the changes that are kind of on the horizon to make sure you're abreast of things. Okay, so first up, a look at swap rates and what's been happening, and it's very, very quiet. So 2-year swap rates as of last night were just under 4%. 1 month ago, they were just under 4%, and just over 4%, and 1 year ago they were just under 4.5%. So actually, month on month, things have pretty sort of stayed the same. Year on year, we're 0.5% lower, so that's good at least. 5-year swaps, very similar story. So as of last night, just under 4%. 1 month ago, just under 4%, and 1 year ago, just under 4%. So everything's kind of really not moved. Even when we look at year to year, where things are obviously lots gone on in the middle. So in terms of how this is impacting your mortgage rates, so what you're going to see in a moment when we do the lender pricing changes, there's not a huge amount of change because lenders have no real kind of impetus to change their rates. Their pricing hasn't changed. So those who are shaving very, very small amounts off their deals at the moment, they're doing so because either they haven't repriced downwards for quite a while, so they have some scope to do so. They're looking to make very small changes on their rates to try and gain some market edge. But fundamentally, lenders' cost of funds hasn't changed. Therefore, they don't have the ability to make any big changes to the mortgage rates they're bringing to market. Now, in terms of looking forwards and what could change this, so what we have on the horizon, which could be an adverse impact on swap rates, obviously Donald Trump. Secondly, we have the spring statement coming up as well, so that could cause some kind of issues. Latest inflation data, we've got an MPC meeting coming up as well, so there's lots of different things which may adversely also positively impact the market. The things that are looking quite good at the moment, so there's lots of talk about kind of some peace deals being signed, particularly with Ukraine and Russia, and also in Israel as well, so those could potentially settle the markets a little bit. Obviously, if we see inflation data come down unexpectedly, that could also serve a good purpose, and also if the MPC make a kind of radical decision in terms of what they do with base rate. But as we know, the markets have already priced in what they think is going to happen with base rate. So if it performs in the way that they predicted, then they're not going to radically change swap rates. They won't be impacted because these changes have already been built in. It's only if MPC do something which is a little bit kind of left of centre, a bit different to what they're expecting, that then that would make any material difference to pricing. So I think really, in terms of mortgage interest rates, and for those of you who are waiting for things to come down, right now, as it stands at the moment, I can't see anything changing anytime soon. I've just realised that I've made it sound really negative that swap rates aren't bouncing around all over the place. And obviously we'd like them to come down, but the really good news is that they're staying very static at the moment. So the first thing is, and most importantly, they're not going up. The second thing is that actually when swap rates are very, very static, they're not volatile. What the lenders are able to do is kind of drop pricing down a little bit, because what lenders will always do in a time of volatility with their pricing going up and down, they're always going to build in a bit of an extra margin, a bit of a cushion, so that they can absorb any fluctuations or small fluctuations in their cost of funds rather than having to reprice their products every 5 minutes. So actually there is some positives in here. I know I've just made it sound really negative. So in terms of what's been happening in the world of mortgages, like I say, it's been a really quiet week in terms of pricing changes, with only really 3 notable changes to talk about. So the first one is that Clydesdale have dropped their pricing down by up to 0.15%. Now, Clydesdale are a lender who very, very nearly, they're aiming for a very specific part of the market. And we alluded to these kinds of borrowers last week when we talked about Barclays and Bank of Ireland. So Clydesdale are a lender who do not want to lend to people with large portfolios by any stretch of the imagination. They're not lending on limited companies, they're not lending on HMOs, they're not lending on multi-units. What they're doing is they're lending to people who have maybe 1 or 2 buy-to-let properties. These people would be good income earners who have lots of disposable income. So where Clydesdale really come into their own is if you have a buy-to-let property where the rental calculation isn't working out. What they do is they bring affordability into the picture, and so they're going to use your own disposable income to kind of top up any shortfalls in rental income. So they can be really, really good. It tends to work particularly well. I'm going to really stereotype here, but for those people who are probably in London and the southeast, so high income earners where the yields aren't working out, these guys need a mortgage. They've got lots of disposable income. They can afford to absorb any shortfall in the rental calculations. That's where Clydesdale really come into their own. Now, we've seen the mortgage works decrease some rates by up to 0.3% across the ranges. Obviously, you guys will know who the mortgage works is, largest UK buy-to-let lender. How are they pricing at the moment? They're pretty keen, actually. They went off the boil for a little while, jostling for position at the moment. Things we use TMW for a lot. So first of all, what they have done as a lender, which I find really commendable, is they have tried to be pretty much all things to all people. So they have an offering for standard properties in personal names for those landlords with less than 10 buy-to-lets. They have an HMO offering. It's a fairly conservative one, but it's an offering nonetheless. They don't lend on multi-units. They do have a limited company range also. And then they also have a different product set for those landlords who are borrowing personally, who have more than 10 properties in the background. And actually, for a lot of borrowers, the mortgage works price up really competitively, so definitely one to keep in mind. I really like them. They're really, really efficient. What I would say is you either fit with the mortgage works or you don't. There is like no room for discussion whatsoever. So if you were thinking about applying for a mortgage works mortgage, one of the things I would definitely do is be very rigorous in checking their criteria to make sure it fits for you. Ideally let someone like us do that on your behalf. That'd be much easier for you. And the second thing just to say is that they can be quite hard to pass credit scoring with. And one of the things that we find comes up often with the mortgage works is if someone is, and the terminology we would use is over 60% utilised on credit lines. So what that would mean is if you had a bunch of credit cards with credit card limits totalling £10,000 and you had £5,700 worth of outstanding balance on those credit cards, and the rest of your credit file was perfect, then there's a strong chance you would pass credit scoring with TMW. However, if actually you, in the same circumstance, you had £7,000 worth of borrowing utilised on those credit cards, you would probably find you'd fall outside of credit scoring with the mortgage works, despite the fact that your overall credit score, when you look at it online, is absolutely pristine. So they can be quite funny about that. But good news, nonetheless, up to 0.3% from one of the largest buy-to-let lenders in the UK is to be encouraged and celebrated. And finally, our lovely friends at the at YBS Commercial have dropped their rates down by 0.1%. So quite a small reduction, but a reduction nonetheless. And because they tend to deal in larger loans, so their minimum loan size tends to be around £500,000. Even 0.1% reduction can make a large difference. Just to recap, YBS, absolutely fantastic for all things specialists. So large HMOs, no maximum number of rooms, multi-units, no maximum number of units there. They're looking to ideally lend to limited companies. They can look at fairly complex ownership structures. They also do semi-commercial and holiday lets as well, where they're looking at the holiday let income. So lots of great things from YBS. Now, what I haven't done for a while is do a pricing roundup for you. So what I thought I would do is just give you a bit of an example about rates and how they're looking. Because it's all very well saying rates have come down by 0.1%, but actually what does that mean? They actually are. So what I've done is I've taken the example of a property worth £300,000, which is broadly the UK average at the moment, and I've taken the example of borrowing a 75% mortgage because people are looking to acquire properties tend to go in that level. I appreciate if you're remortgaging, you might be at 50, 60% loan to value. Obviously, you would get a different set of rates, but 75% loan to value on a loan of £225,000. Now, just to remind you guys of how I do this, what I could do for you is just sit here and give you the lowest interest rate, but that lowest interest rate would probably come with a massive arrangement fee. And overall, looking at the interest you would pay over the 2 or 5 year period, plus the arrangement fee, that deal isn't actually going to be necessarily the best one for you. So what we prefer to do here at MFB as long as our clients are happy for us to kind of work on this basis, is we look at the overall cost over the 2 or 5 year period. So we're bundling in all the interest you're going to pay and all your setup fees, and then the deal which has the lowest cost in the round is the one that we're going to say is the most cost effective. So when we're looking at 2-year fixed rates on that basis at the moment for an individual buying or lending against a straightforward property in personal names, looking at something in the region of a 2-year fix from 4.42% with a 995 fee. 5-year fixes from 4.36% with a 995 fee as well. So actually not bad. If you're a limited company, in the same scenario, 2-year fixes from 5.69% with a 1499 fee, 5-year fixes from 5.24% with a 1499 fee. And if it's an HMO, and by HMOs, what I'm not talking about is a 3-bedroom flat with, say, 3 shares. What we're talking about is proper HMOs here. Your 2-year fixed rates are from 6.09% with no fee, and 5 years from 5.19% with a 6750 fee, so £6,750. Now, like I say, there are lower interest rates available, but they will have higher setup fees. So these are the deals that in the round would work out best on a loan of £225,000. Now, actually, one thing that I was just thinking about as I was reading this out is actually for those of you who have been mulling over whether to go onto a standard variable rate, and these are currently sitting at between sort of 7.5% and 10%. But you've been thinking, well, maybe I'll just go into the variable rate rather than taking a fixed rate at the moment because, quite frankly, it's not worth it. Actually, when we look at rates of like 4.36 with a 995 fee, and these incidentally on remortgages often have free valuations and free legals as well, actually, I think there is very much an argument that you're going to be better off taking those products rather than paying an interest rate of 8.5%, 9%. But as always, we'd be delighted to help you with those calculations if you are in that boat to see whether it would actually be beneficial for you to think about remortgaging at the moment. Criteria changes have been quite this week. We've seen just one be announced from Santander. So Santander in the buy-to-let space, I'd say they kind of play at it. I wouldn't say they're prolifically into it by any stretch of the imagination. I don't think they'd say it either, to be fair. But actually they do have an offering. The pricing tends to be quite competitive, and they have some, a couple of things under their belt which are quite unique in terms of lending criteria. So, good enough lender. So what they've done is they've changed their rental calculations. So when they're looking to lend you money, and bearing in mind they're lending to individuals only, no limited companies, if you're applying for a 5-year fixed rate, previously the calculation would have been 145%, assuming an interest rate of 5.15. This is now dropped to 4.99. If you were taking anything other than a 5-year fixed rate, the calculation would have been 145%, assuming an interest rate of 7.15. Now it's 6.99. And previously, if you were doing a like-for-like remortgage, irrespective of whether it was a 2 or a 5-year fix, it would have been a 5.15 rate they stressed at. Now it's 4.99. So in short, what this means for you is that if you are applying to Santander, they can now lend you more money per pound of rental income than they could previously. Okay, now I just want to share some data on what's happening in the housing market, because I think it does actually really kind of drive home that there is opportunity out there for investors at the moment. So the first thing that you need to know is that new listings are still running hot, but they are kind of easing back towards an average figure from the start of the year. So at the start of this year, listings are at their highest level since 2016. They were 8% higher than they were in 2024 and 17.6% higher than the pre-pandemic average. So there were loads and loads of properties coming onto the market. When there's lots of properties on the market, as we know, the pendulum tends to swing in favour of buyers because it opens the door for much more negotiation. And this really kind of hammers the point home that 12% of the stock listed for sale continues to be reduced. Now in 2024, the average number of properties which got reduced were 12.1%, so we're kind of on a continuum from 2024, but the 5-year average is 10.6%, which tells us that actually, because there's more stock for sale, it means that more properties are having to be reduced. To give you some numbers in terms of what this looks like, in week 9 of this year, there were 26,700 properties sold subject to contract, 25% higher than the pre-pandemic levels. Of these sold subject to contract properties, 24.3% of these sales fell through, and this is actually bang on the average. So in terms of sale completions, things are performing in a very kind of normal fashion, but I still find it horrifying that for those of you who are trying to sell a property, there's a 1 in 4 chance that the sale's going to fall through, which, as you know, if you've ever sold a property before, is really, really frustrating and worrying. Now, at the start of this month, there were 675,000 homes for sale in the UK, 50,000 more than the same date in 2024. In 2022, there were just under 400,000 homes for sale. So the number of properties for sale in the market has just been going up and up. The average pound per foot of property in February was £340, which is down £2 from the January figure. So it definitely shows that actually it's a kind of shaky market at the moment. Now, when I say shaky, I don't think it's going to fall. I don't think we're in for a property crash or anything like that, because as we're seeing, the number of listings is starting to slow down. But always when there's a kind of abundance of properties for sale, it paves the way for more properties or people having to negotiate on the sale prices, essentially. So I think really the message here, and what I take away from that is, if you're thinking about investing, is actually there is an opportunity at the moment to really go and negotiate on properties. Sellers are finding it quite hard to sell properties. We've got a lot of landlords, incidentally, who we're speaking to and saying, I think I'm going to sell my buy-to-let. I'm come to the end of my rate. It's a good time to get a property sold. They're sitting on the SVR, paying those awful 8, 9, 10% interest rates. The property simply isn't selling, or unfortunately they're one of the 25% who see their sale fall through. They've just spent months on the variable rate. They take the decision that actually the market is just not a kind market to be selling properties at the moment. So they decide to retain it and re-let it back out and come back to it in a couple of years' time. So lots of food for thought there in terms of plans for the future. But like I say, could be a good time if you are thinking about property shopping this year to get going. Now, we know the Labour government are very, very busy bees at the moment, and there's lots of legislation going on that's going to impact the PRS. So we're going to try and keep you as up to date on that as we possibly can. And last week, we talked about the Common Hold white paper, which is going into consultation over the summer. So we'll keep you updated on that as and when stuff comes out that's going to be relevant to you. But also, none of us can forget about the fact we've got the Renters' Rights Bill looming in the background. So just to give you an update on that with timings particularly. So at the moment, another week's just gone by without any news on when the committee stage of the House of Lords is going to take place. And there's also not seen the government amendments, which are the things that are really going to matter, because these are the ones that are going to make changes to the bill. So what we've got to think about is the timing here. So we're about to go into the Easter recess. So royal assent is probably not going to happen till probably June time now. So actually the reality is that, and I think my kind of best guess would be that any kind of implementation of the Renters' Rights Bill being passed into law probably will be until October, possibly even going out towards the end of this year or early next. So that's where we are with the Renters' Rights Bill. So it's plodding along at the moment. Now, there's also been an announcement of another bill which probably hasn't been on your radar quite so much, because as property investors, you wouldn't necessarily think this impacts you, but I think it's always just worth being aware of these things that are in the ether. And this is the new Planning and Infrastructure Bill. So it had its first reading in the House of Commons on Tuesday. Its second reading has already been scheduled for the 24th of March. And the press release to the bill refers to it as the biggest building boom in a generation through planning reform. And heralds that by ensuring shovels can be put in the ground more quickly and projects are freed from unnecessary bureaucracy, these measures will help deliver a building boom that will deliver a major boost to the economy worth millions of pounds, or billions of pounds rather, and create tens of thousands of more jobs as houses and infrastructure are built. So really coming back to the very ambitious target that Labour have for the number of homes that are going to be built in the UK over their parliament. So I just thought it'd be important to kind of run through with you the pros and cons to the bill, as you as property investors might be interested in. So first of all, there are some pros for you guys. So for those of you who do dabble or are thinking about dabbling in some conversions, development, that kind of thing, some more on the building side, what this bill should bring to us is an accelerated set of infrastructure delivery. So actually making the process, particularly around planning, for you guys to be able to kind of get on with things a lot quicker. We have heard stories, we've had clients before who have been looking to do developments. There was a guy who immediately springs to mind, where there was some particular kind of bird nesting in the building that he was looking to do. So he had to actually wait for nesting season to pass, and the birds and their little birdlets, what are baby birds called? Chicks, to be out of the nest before they could actually do any work to the property. So this meant the whole thing went on ice, and it was really, really expensive for him. So this is the kind of stuff that's being reviewed to see if it will help things. There's also going to be a nature restoration fund introduced. Great news for nature. That's going to be funded probably by property developers of course. And also the other kind of benefit here, the benefit to the Restoration Fund is obviously the kind of trade-off where if you're going to loosen planning laws and conservation for nature, how are you going to then combat that, and what are you going to put in place to balance things out? Another benefit would be that there's going to be obviously economic growth and job creation if lots of homes are getting built, and actually the housing industry contributes hugely to the UK economy. That can be a really, really positive thing. So in terms of you guys, there's going to be some real opportunities to go out and do some kind of more chunky refurb and building projects. I think that's really the big one, and hopefully on balance with that, there's going to be some real protection of nature. Downsides. So there's some real environmental concerns here. So people are very, very worried that actually it's going to be a case, and I know bats always get referenced, which is fine, but actually, genuinely, what is the impact going to be on our nature in the UK if we start giving people a lot more freedom? Also, the impact on local communities. So actually, is there going to be kind of conservation rules around, for example, our very pretty market towns, which have always been quite protected? Is it going to be that you can just go and chuck up a bunch of kind of cheaper accommodation in those areas? So actually, are the characteristics of certain areas, for example, going to be considered and protected? Now, some are actually saying that the bill doesn't go far enough, and the reviews to the bill or development planning rules are going to be quite modest. And actually developers are still going to be very much hindered in terms of requirements and cost as well. So some people are saying that it simply isn't enough. So in terms of for you guys as investors, I think really the kind of key thing here is that there's an opportunity for development. Also, regeneration of areas can lead to potential investment opportunities. So if you took an area that was in need of some real regeneration, there's a bunch of cheap properties for sale. Someone's going to invest loads of money and really driving up the Airbnb, building some higher quality accommodation. Actually, the opportunity for you as an investor could be to come in and invest in some of those cheaper properties, which will mean there's more affordable housing to rent in that particular area. The cons are certainly going to be that there could be more homes for sale, which means that actually there's going to be less people buying property because people are going to be able to afford to buy their own homes, and that could mean there's going to be less renters in the PRS. It also means there could be an increase in tenant mobility as there's more homes available around the UK, which could lead to extra churn in terms of tenants, which, as we all know, as landlords, can be quite costly. So pros and cons with this one, and once again, we'll keep you updated as things develop. Goodness me, another busy news week. That's everything for me this time around. So just left for me to wish you a wonderful week. And as always, if you have any questions, please do get in touch. We'd love to hear from you, 0345 345 6788. Just to say apologies, obviously the sun's come out and I've got a cold, so if I sound a bit grotty today, sorry for that. Look forward to seeing you next time around. Have a great week, a super weekend, and take care.